Good morning, everyone. This is Scott Davila with Capital Management Corp. I am the Vice President and Director of Marketing, and we appreciate you joining us this morning for our quarterly webinar. With me today are Tim Call, President and Chief Investment Officer for Capital Management Corporation, and Mark Livesay, who is Vice President and Portfolio Manager. Before we get started, a few housekeeping items to pass along to you. Today's webinar, as our past ones have been, will last about 30 minutes, and we'll have a Q&A at the end. For questions, you're going to see on the right side of your toolbar a caret with questions next to it. You can click on the caret, drop down, you can type in your question to us. You can send it privately or to the whole group. We've already got a couple questions that we'll address at the end. And it's a pretty simple process, so if you have any challenges with that, you feel free to send us questions after the webinar through email. We also are recording this webinar today, as we have in the past. We will post it under the news section, along with the other ones that we have done, as well as other information. I'll talk about what's under the news section at the end of the webinar so that you understand what educational resources are available to you. So, without further ado, I'm going to go ahead and get started. And sorry about that. And discuss what we're going to talk about this afternoon. Per our email invitation, today's agenda is going to be up front. Tim and Mark are going to talk about the economic backdrop that exists today. Mark will get into the banking situation. I know that's top of mind for a lot of folks. Also discuss our recurring friend or foe, as we should call it, which is inflation, and where that is today and where it might be headed in the future. And then Tim's going to talk a little bit about a potential looming recession, which we've discussed multiple times in past webinars, and then we'll get into what we believe are some prudent long-term investment principles to follow during this volatile and uncertain time, as well as some actions to take considering where we are today with the market and where it may be heading in the future. So with that said, I'm going to pass it over to Mark and let him get started.
Thank you, Scott. So we're going to start with probably the biggest piece of news coming out of the first quarter, which was during late in the first quarter in mid-March, we saw the failure and subsequent takeover of three high-profile banks, Silicon Valley Bank, Signature Bank, and Credit Suisse. Each was a unique situation, and each now has been taken over by another bank. First Citizens took over Silicon Valley, New York Community gobbled up Signature, and the two largest Swiss banks ended up in combination with UBS taking over Credit Suisse. Silicon Valley and Signature represented the second and third largest bank failures in the history of the U.S. They were only eclipsed by the 2008 failure of Washington Mutual, so it was a big event. For Silicon Valley, it was unique. It was not a case of loans not being repaid, but rather just duration mismatch between deposits and longer dated bonds that they had purchased at very low interest rates. So they purchased these bonds at low rates in 2000 and 2001 after Silicon Valley customers were able to raise tons of venture capital. Customers kept much of this new capital as deposits with the bank. When they bought these bonds, many were longer dated U.S. Treasuries and mortgage-backed securities, and they characterized and accounted those as held to maturity. This is because the company did not envision having to sell these bonds. When you hold something or classify something as held to maturity, the assets are held at cost. Therefore, losses due to changes in interest rates were not reflected on the income statement or on the balance sheet. However, when customers began to withdraw deposits faster than anticipated, the company needed to sell bonds in order to fund the withdrawals. However, when you sell these bonds, the losses are recognized, of course. The bank attempted to raise more capital from the equity market to offset losses from the bonds, but when they announced the capital raise, it failed and then exacerbated the problem by leading to an old-fashioned run on the bank. So when many customers come in to take all their money out at the same time, the bank doesn't have all those deposits on hand and was taken over by the FDIC and eventually First Citizens, as I mentioned. Signature then suffered a similar fate as depositors became concerned about losses on their held-to-maturity portfolio and also their exposure to cryptocurrency. So there was a lot of work, and the Federal Reserve responded to this turmoil with a new program called the Bank Term Funding Program, BTFP. This allows banks to borrow short-term from the Fed using their bonds as collateral based on par values, cost values, not the lower market values after interest rates have increased. In this way, banks could avoid selling the securities or bonds at losses and still fund potential deposit outflows. Since this happened about 4 or 5 weeks ago, it's still early days, but the fallout appears to be contained. Many believe that if a depositor was going to panic and be involved in a run on the bank, that would have happened by now. So you are more likely to panic and pull your money from your bank in mid-March than you are in mid-April because the panic has subsided. There are some longer-term implications, and these failures led to extreme volatility in the bonds market. An example of that is the 2-year Treasury has moved a total of 50 basis points, or said another way, 0.5%, just 4 times this millennium. The first time was in September of 2008 during the height of the global financial crisis. All other 3 times occurred in March of 2023. So we really did see unprecedented bond volatility during this time period. The disorder in the banking system is likely to lead to higher deposit costs for banks, so they'll have to pay their depositors more over time. This could lead to higher borrowing costs, so meaning they'll charge more for loans for consumers and businesses. They'll also likely tighten up credit conditions, which could slow the economy. Ultimately, these higher borrowing costs and tighter credit conditions could, however, help the Fed in its mission to lower inflation, which it's been on for about 14 months now. So we'll turn to inflation. And in this slide, we break up inflation by a couple big categories. Annualizing the most recent March increase month over month of 0.3% would represent annual inflation of 3.6%, certainly down from last summer's peak, but still higher than we'd like to see and higher than the Fed's 2% target. Food inflation continues to run hot. It was up 8.5% over last year. However, if you look more recently, the data is more encouraging, particularly for food at home, with prices falling from February to March. Egg prices, as probably all of us are aware, have spiked due to an avian flu, and as the impact of that flu wanes over time, we should end up seeing lower egg prices, and it appears that has begun. Energy prices are lower than they were a year ago, down 6.4%, also down what they were from February to March. Energy prices are always volatile, and that's why some people remove energy when they talk about core inflation. Weather impacts, whether you need to heat or cool a lot, depending on if you have a severe summer or severe winter, impact energy prices, and also supply from OPEC. So those things are kind of non-financial components that do impact inflation. And then down at the bottom within services, we've talked about this a lot. The shelter component does account for roughly a third of the entire index, and that does remain stubbornly high, up 7.1% from a year ago and up 0.5% from month to month, which would be 6% on an annualized basis. Part of this is because the owner's equivalent rent calculations tend to lag, and part is due to housing prices remaining high with very low inventories of houses available for sale. So even with higher interest rates, housing prices have not cracked. Given the low inventory of houses available in most markets, we do not anticipate a crash in housing prices on the near-term horizon, even though the Fed might like to see that to help inflation come down. So given the likely stickiness in many pockets of inflation, we find it hard to imagine that the Fed is going to cut interest rates this year. I would note that it appears Wall Street does predict a cut at the end of 2023, so they must be looking at something else because it's hard to imagine inflation going back to 2% by the end of the year. Moving on to another very important part of the economy, labor, and this chart represents job openings. Despite openings falling from recent peaks, job seekers are still in high demand, and openings remain much higher than the average over the last 50 years. Many of you have probably seen layoffs at large companies in the news. They tend to grab media attention. We've seen headlines of Meta laying off 10,000 of its 87,000 employees since late last year. Amazon is reportedly laying off roughly 18,000 people. Computer maker Dell is cutting roughly 6,500 jobs, and Google is reducing its staff by 12,000. Twitter has reportedly cut its staff by at least 75% since Elon Musk purchased the company. So even though we're seeing some headline layoffs, we have not seen the job openings really crack. And given the supply of job openings, these newly laid off workers should be able to find new work. However, that doesn't guarantee that they can find a job as good or as high paying as the one that they left. So that is an issue. And we do keep our eye on average hourly earnings, and that growth has decelerated. It's still up over the last 12, 18, 24 months, but that growth is decelerating, so meaning the rate of growth is slowing, which could also eventually help lower inflation. I would note that given the U.S. consumer makes up 2/3 of the economy, we're going to be watching labor trends very closely to gauge the overall health of the economy. It is hard to imagine a severe recession coinciding with a very strong labor market, so I would note that, but we are keeping our eye on it. And I will pass the call over to Tim to talk more about some broader trends.
Thank you, Mark. This will be the most discussed recession coming up if we end up in recession. And every recession is different. As Mark stated, it's odd to go into recession with a surge in hospitality and restaurant labor hires. But as the tech industry lays off high wage workers and hospitality adds lower wage jobs, there could be a little bit of a dampening in the average wages reported by the federal government, despite the great wage pressure. As you see on this page, every recession can get a different name. These are recessions or related events over the last 50 years. 1989's savings and loan crisis resulted from rapidly rising overnight interest rates. Banks had lent money and provided long-term mortgages at fixed rates, but as the Federal Reserve raised overnight interest rates to slow inflation, bank depositors needed to receive those higher rates on their deposits. Eventually, many banks were paying their depositors at higher interest rates than their loans were making. As banks lost money, many were taken over by regulators. Their assets and foreclosed properties were held by the RTC, Resolution Trust Corporation, and eventually sold at market prices. Being a federal agency, the RTC could borrow at lower interest rates. By the time the episode was over, the RTC had made money. The eventual outcome of financial crises, bailouts, is that the bailout mechanism buying distressed assets at the bottom of the market can eventually sell them at a profit years later. This happened with the Brady bonds used in the Latin American crisis. It could happen with quantitative easing programs after the financial crisis of 15 years ago. However, in recent years, some banks purchased long-term bonds and mortgages yielding less than 3%, and the Federal Reserve has raised interest rates from 0 to 5. And so, as Mark stated, we have more instances of banks having to pay borrowers more than what they're receiving on their long-term investments. Luckily, many bank executives know past history and did not fall into this trap. The current stock market backdrop appears actually more similar to the Y2K and .com bubble. The 1990s saw a long 10-year large cap growth stock surge. And by 1996, Fed Chair Alan Greenspan referred to the stock rally as irrational exuberance. The pinnacle of this rally was reached in early 2000 as the Federal Reserve provided extra liquidity or money printing to the economy in case the Y2 computer programming transition from 2 digits to 4-digit years caused disruption. Just like today, the Federal Reserve had been raising interest rates. As the Fed continued to raise interest rates and remove their Y2K liquidity from the economy slowed and the extended large cap growth rally collapsed. The subsequent 10-year returns for the largest capitalization stocks were subpar, and the S&P 500 logged a negative cumulative return over the subsequent decade from 2000 through 2009. There was another extended 10-year large cap growth rally in the 1960s, which was referred to as the Nifty 50. No matter what the price, one had to ignore normal growing companies and just buy the leaders in this group of 50 stocks for the next century. These stocks included Eastman Kodak, Polaroid, and Xerox. This large cap growth rally ended in 1972 with the Dow Jones Industrial Average at 1,000. From 1972 to 1982, it was hard to make money in the Dow Jones. Finally, 10 years after the Nifty 50 peak, the Dow Jones broke above 1,000 and remains above 1,000 today. Well, the 10-year periods after those large cap growth cycles were subpar for large cap growth stocks. And now we've just experienced a 12-year extended large cap growth rally. So much so we have mega caps. Some of them will be leaders in 10 years, but like Kodak, Polaroid, and Xerox in the 1970s, some large cap stocks priced for perfection will generate losses for investors. On the other hand, overlooked, undervalued, growing companies can perform well. While lots of investor money is in mega cap stocks and large cap index funds, institutions, endowments, foundations, pension funds, and others are underweight small caps, mid caps, firms with low valuations, dividend payers, and dividend growers. Overlooked areas of the market should outperform overvalued large cap stocks, which, as Mark stated, are laying off employees in order to preserve profits. Those are stocks that should not be priced for perfection right now. As this change occurs, investors will start allocating more funds to strategies that benefit from investing in smaller firms with lower valuations and possibly dividends. The baby boomers will need dividend payers in retirement. In a decade of subpar large cap index returns, institutions will also need cash dividend support and stocks that make money. Meanwhile, ultra short bonds yield close to 5%, while long-term bonds yield closer to 3%. We think the Federal Reserve will continue to keep overnight rates at 5% or so, and long-term rates should rise and close that gap. As long-term bond rates rise, long-term bond investors can lose money. So we recommend that bond investors remain in short-term ladders and gain from 5% interest rates. On the next slide, some of the valuation disparities are shown. Price to earnings multiples for stocks of companies of 12 to 15 are normal. So as you see on this page, large caps appear overvalued. Over longer periods of time, small caps and mid caps tend to have higher valuations than large caps. So we see an inversion here. Moving to normal long-term trends will not happen in a straight line. The stock market will always have volatility. In last year's bear market, the stock market experienced double-digit losses. Well, it's done that in 24 of the previous 43 years. Yet, in 17 of those 24 years, the S&P 500 logged a positive return for the full year. It is normal to have emotions, but emotions can be your worst enemy when investing. At market lows, emotions lead some to sell. That's why the lows are so low, those extra sellers. That is when one should be buying. Those are very attractive long-term entry points. The key for investors is to forget your normal human emotions and return to a focus on your long-term investment principles. And with that, I'll turn it over to Scott.
To add to Tim's point, dating back to 1980 through last year, we've had some very major declines in the market. For us old enough, we can remember Black Monday in the late 1980s, the tech bubble, the global financial crisis, and most recently the pandemic, many of those that you saw on Tim's recession slide. But despite these major setbacks, the S&P 500 had an average annualized return over that period of around 11.5% if all dividends were reinvested. And if you adjusted that for inflation, it was around 8.2%. So timing can be fatal, and I know we've discussed this many times during past webinars that it's not about timing the market, but it's time in the market. So it's important to focus on your long-term investing goals and timeline to reach those goals. So instead of worrying so much about market volatility, which we have and will continue to have, investors should be focusing on the risk of inflation that exists today, as well as the rate of withdrawals from their accounts to preserve and grow their savings. For instance, if you think about it, inflation is around 5% today. Let's say you are withdrawing from your accounts at 4% annually. Well, then you need a 9% return to preserve your principal. So with inflation so hard, it may make sense for some investors to consider adjusting their rates, their withdrawal rates, in this period of high inflation. The prudent strategy today, and actually in any environment, is to revisit your goals and plans for all your accounts. And you should be doing that annually, but in particular with a high inflationary scenario that we're facing today. Calculate and understand the income you need, want to pay for things that are important to you, such as travel, family events, maybe even college education for your kids or grandkids, and so forth, with the focus of preserving your principal. When you do this, it's important to factor in the requirements of each of your accounts. For those who have IRAs, the requirement for RMDs will kick in. your trust beneficiary payments, as well as restrictions and tax status of each of your accounts. And the reason to do that is that you want to maximize the potential of your long-term goals as well as your long-term investments. At the end of the day, the focus needs to be on growing your accounts faster than inflation. Key strategy of preserving wealth, particularly in today's environment and principle, is investing in companies that pay dividends. As you can see on the slide, over the last century, approximately half of the stock market returns were from dividends when they were reinvested. 80% of our approved stock holdings pay dividends. And the reason why we focus on those companies is because dividends, number one, provide an income to support your spending without invading principal. Two, they offset inflation, which you're going to see on subsequent slides, the yields of our model portfolios. And thirdly, their dividends are more tax efficient than U.S. Treasuries and corporate bonds. For that, I'm going to pass it over to Mark.
Thank you, Scott. This chart just shows the yields on our different model portfolios at the end of the first quarter. So we do focus on finding cash cows that are generating enough cash to fund expansion, pay down debt, and also return cash to shareholders. Many of the companies we've found have attractive dividend yields, and most of those have a history of increasing their dividends annually. Currently, all strategies offer dividend yields greater than the S&P 500. And as Scott mentioned, we think that's so important because this income can support annual withdrawals or RMDs and also enable portfolios to grow without invading the principal. Dividends are also more predictable than stock prices. So on any given day, we don't know what the stock price will be, but knowing we have that dividend supporting us, we can be less emotional about paper declines in stock prices, knowing that cash income continues to be generated for the portfolio. We're also going to talk a little bit about valuation on the next slide. So even after we find a company that is a good cash cow, we do not want to pay too much for the stock. Fortunately for us right now, the overall market appears to still be infatuated with mega cap growth companies and is leaving many cash cows undiscovered and therefore at attractive PE valuations. The estimated PE ratios of all of our strategies are shown, and most well below the valuation multiple of the S&P 500. These low valuation metrics, such as high dividend yields and low PEs, should provide a margin of safety. These growing cash cows can also provide a nice upside as the market shifts focus away from the rearview mirror and what worked over the last decade to companies generating cash with their stocks trading at discounted valuations. So with that, I'm going to turn it back to Scott to handle compiling the Q&A.
Thanks, Mark. We do have one question that's in. The first question, Mark, this is probably for you. Is the banking crisis over? What can we expect moving forward?
Well, I think is it over is a tough question. I think it's probably too early to fully declare victory. But as I mentioned on the slide, it does seem like it has been contained. And one of the major differences between this crisis and the crisis of 2008, which I think most remember, is that this was not a problem with bad loans or bad assets or the bank holding something that they thought was worth $1 that's ultimately worth 50 cents. This is more of a duration mismatch, and that they're holding something that they thought was worth $1 that's still worth $1. It's just not going to be paid to them right now. They can't get $1 for it today. They will ultimately get their full value back. And it does seem contained. And so far, the smaller regionals that have reported earnings have not reported huge declines in deposits. So that will continue. Those reports will continue over the next 2 weeks. But we do feel pretty good about the worst of the situation being behind us. although I would say it is hard to say that something's completely over until we get a little more than a month past the heat of the problem.
Thanks, Mark. So the next question is, with a potential debt ceiling crisis looming and parties being far apart, scroll down the rest of this, what do you feel the impact will be on the economy markets should the U.S. default on its debt?
The United States should never default on its debt. So this is a negotiation that goes on every couple of years. They've had these debt ceiling negotiations certainly more than 10 times. Each time the resolution has been to raise the debt ceiling, with the offset being an agreement to lower spending, or lower the trend line of spending, or lower the agreed spending amounts. This tends to be occur through legislatures meeting with each other and negotiating with the White House. Right now, it's harder to negotiate with the White House, and sometimes you don't know where the decisions are being made there. But ultimately, the budgets and the power of money being spent by the government is held by Congress. So Congress needs to approve a bill, whether they do that in advance or last minute. And what we will probably see are that the congressional leaders are meeting with the Senate leaders and coming up with something they can live with. And they'll have it on the president's desk if they need to have short-term extensions of the debt ceiling until they get the wording finalized, then that can happen. But the House and the Senate need to agree on a package. And once they pass that, we think the president will have no options but to sign whatever they provide to him. And that's the situation he's putting himself in by not negotiating with the House and the Senate right now. This has regretfully become a normal process in the United States. This is not what any of us want to see, but it's been a recurring process, and the media likes to make things even more exciting than they are so that they get repeat viewers. So this is the soap opera that we're all viewing right now, and have to tune in again tomorrow to hear pretty much the same thing. So a last minute legislative breakthrough, possibly after some debt ceiling increase extensions while they make the wording final.
Thanks, Tim. It doesn't appear that we have any more questions, and we are right at 30 minutes. If you do have a question or you think of one after this webinar, feel free to email us. I do want to remind everyone that we have recorded this. We will post it under the news section likely on Monday. If you haven't visited our website in a while, we have some great resources under the news section, including a retirement toolkit, as well as information on the Secure Act 2.0, which changed some retirement provisions. So feel free to visit that section of our website as well. With that, we wish everyone a great rest of the day as well as upcoming weekend. Thank you for attending.
Thank you.